I mean, and also maybe just to kind of return to a normal dynamic, right? Stocks are up, bonds are down. Maybe that kind of works out every once in a while. But, that's anyway. So we have the possibility of higher inflation and maybe slower economic growth, right? Those concerns are growing on Wall Street about the possibility of stagflation. But is it stagflation or something different? And what exactly is on the horizon? Should traders just adjust their portfolios accordingly, given the stagflation narrative? So joining us now is Jay Hatfield, the CEO and CIO of Infrastructure Capital Partners. And Jay, this is interesting because we are talking about stagflation and kind of people are getting more familiar with it. But you're thinking about something that's more something called stagdeflation. So take us through what that means.
Right, thanks, Dom and Kelly. It's great to be on. So if you really look at stagflation, that happened during the 70s. And we follow oil. I founded an energy company. Inflation was driven primarily by higher oil prices. They went up an unimaginable 1,200%. So it's the equivalent of oil being over $1,000 a barrel, well over $1,000 a barrel. So that's what caused stagflation in the 70s. Here we have the opposite. So we call it somewhat tongue-in-cheek stagdeflation. You have oil down 20%. So not just flat, but down 20 as opposed to up 1,200. That's a tax cut for individuals. It'll offset most of the inflation from tariffs or price increases. I wouldn't even call it inflation. So, and the money supply is negative. Money supply is the best leading indicator of inflation, even though the Fed ignores it. So we do think growth will be 1% to 2%, so that's pretty stagnant. But we think inflation is heading down. Real-time inflation is at 1.3. We think it's going towards zero.
All right, so Jay, if that's the case, how exactly then do you position? What exactly do you kind of put in your portfolios to play for that stag-deflationary environment?
Well, one companies or type of companies that we love, in which our money management business is way better than ours, because they're really the Roach Motel of money management. So all the private equity firms, we've mentioned KKR, are great companies. And they're down about 30% off their highs, but their fundamentals are unchanged. Nobody can take money out. Maybe the realizations get postponed, but there's still great companies that can be sold. And they have great growth. So KKR just reported they grew their fees 15%, AUM 15%. Fantastic, possibly the best brand name financial services. So if there's we think it's tariff panic or tariff tantrum, there's a great opportunity to go buy these permanent capital businesses, great franchises, and you can ride it out knowing that it's not really affected by the market like an investment bank would. It's really just long-term holdings of great companies.
All right, stagdeflation, and the playbook is buying blue chip private equity companies. Jay Hatfield, Infrastructure Capital, thank you very much. We'll see you soon, sir.